In the last episode, we mapped the skeleton of modern money. Merchant credit layered onto metal, banks layered onto credit, central banks layered onto banks, and finally an international order designed to keep trade moving and governments funded. But that story leaves a sharper question hanging in the air. If money began as a claim on something tangible, gold, silver, or at least a legally enforceable promise of redemption, why did the world accept money that is no longer backed by anything physical? And if that link was cut, who gained leverage when money stopped being a receipt for metal and became a policy tool? Open your wallet, look at a banknote, and you'll still see fossils from the old world. Formal seals, solemn language, hints of, "I promise to pay." Even when the promise no longer points to gold, the note carries the echo of redemption. That's not nostalgia. It's history etched into design. So here's the uncomfortable question. If unbacked money can be created by decision, why would anyone trust it at all? Because modern money isn't backed by a shiny substance. It's backed by something more powerful and more controversial. The taxing authority of the state, the legal system that enforces contracts, the banking network that makes payments work, and the credibility of central banks to manage crises without destroying that trust. Today, we're going to follow the path from gold-backed promises to fiat currency, money that works because society collectively treats it as the final settlement of debt, not through secret cabals, but through incentives, wars, depressions, and the hard limits of a metal-based system in an industrial world. For most of history, good money meant money you could exchange for something scarce and widely desired. Gold and silver had the properties rulers and merchants loved: durable, divisible, portable, and difficult to counterfeit. But those properties also imposed a constraint. The supply of money could not expand easily with the needs of a growing economy. In the 1800s, many major economies converged on the classical gold standard. Currencies were defined by a fixed weight of gold, and central banks, at least in principle, would convert banknotes into gold on demand. This system supported the era's great accelerations: railroads, industrial production, and the first wave of globalization. With currencies anchored to the same metal, exchange rates were relatively stable. Contracts could stretch across borders and decades. But the gold standard was never a purely technical machine. It was political. When gold flowed out of a country, the central bank was expected to raise interest rates. Higher rates attracted capital, reduced domestic spending, lowered imports, and pushed wages and prices down until the country became competitive again. That's the neat textbook story. The human story is harsher. Higher rates also mean bankruptcies, layoffs, and social unrest. Deflation makes existing debts heavier in real terms. A system that corrects by forcing wages downward tends to protect creditors and punish workers. As democratic politics expanded and labor gained power, that distributional tension became impossible to ignore. Then came World War I, an industrial conflict the gold standard was not built to finance. Governments suspended convertibility, borrowed massively, and leaned on central banks to support war spending. Money supply growth became a tool of survival. After the war, several countries tried to return to gold at old exchange rates, effectively attempting to rewind time. But economies had changed, debts had piled up, and political tolerance for deflation had collapsed. The interwar years exposed the gold standard's deepest weakness. It forced governments to prioritize external convertibility over domestic stability. The Great Depression turned that weakness into a breaking point. As banks failed and unemployment soared, governments faced a choice: defend the gold peg by tightening policy into a collapsing economy, or abandon gold to regain monetary flexibility. One by one, countries chose flexibility. Britain left gold in 1931. The United States, under Franklin Roosevelt, ended domestic gold convertibility in 1933 and later reset the official gold price. This wasn't the end of gold as a symbol, but it was the end of a belief that gold convertibility would always outrank jobs, bank stability, and political survival. After World War II, leaders tried to rebuild stability without repeating the interwar disaster. The Bretton Woods framework was the compromise. Currencies were pegged to the US dollar, and the dollar was convertible into gold for foreign governments at a fixed price. It put gold at the center, yet added a crucial innovation: capital controls and managed exchange rates. designed to give countries room to pursue domestic employment goals. For a while, it worked. Reconstruction boomed. Trade expanded. Global institutions provided coordination, and the dollar became the world's primary settlement currency. But Bretton Woods carried a contradiction in its foundations. The world needed a growing supply of dollars to support trade and reserves, yet too many dollars would eventually exceed the U.S. gold stock that supposedly backed them. The more successful the system became, the more it strained its own promise. To understand why money became unbacked, you have to understand what backed really meant in practice. In a gold-linked system, the central bank promises conversion at a fixed rate. If you hold dollars, you should be able, at least in theory, to exchange them for gold. That promise disciplines monetary policy. If the central bank creates too much money relative to demand, holders will prefer gold. They exchange paper for metal, draining reserves. That drain forces the central bank to tighten, raise rates, shrink credit, and slow the economy until confidence returns. Gold convertibility is a constraint, and constraints shape power. But the constraint is not free. In a modern economy, it creates three structural problems. First, money demand isn't stable. In a growing economy, people need more money to transact. Under gold, the supply can't expand quickly unless new gold is mined or flows in from abroad. When money demand rises faster than supply, prices tend to fall. Deflation. Deflation sounds pleasant until you notice the side effects. It raises the real burden of debt, discourages investment, and can trap an economy in stagnation. A society that runs on loans cannot easily tolerate a currency that grows too slowly. Second, banking creates money through credit, but gold does not expand with credit. Even under gold, commercial banks could create deposits by lending. That means the money supply could expand faster than gold reserves. The system worked as long as confidence held and not everyone demanded conversion at once. In practice, gold constraints often forced sudden tightening during stress, exactly when an economy needed liquidity most. That's why gold-era finance is filled with panics. Moments when the promise of redemption turned from comfort into a trigger. Third, fixed exchange rates collide with independent policy. If a country pegs its currency to gold, or to a currency pegged to gold, then it must often subordinate domestic interest rates to the peg. If it tries to cut rates to fight unemployment while capital is fleeing, it risks losing reserves. Defend the peg, and you sacrifice domestic goals. Protect domestic goals, and you weaken the peg. Economists often compress this into a simple rule. You cannot have a fixed exchange rate, free capital flows, and an independent monetary policy all at the same time. Something has to give. Bretton Woods tried to make this triangle workable by limiting capital mobility through controls. But finance evolves faster than rules. Offshore dollar markets grew, especially the Eurodollar system, dollar deposits held outside the United States. These dollars were convenient for global trade, but they were also beyond direct U.S. reserve constraints. The supply of dollar claims expanded globally, while the U.S. gold stock did not. Now at geopolitics and domestic policy. The United States ran persistent deficits, partly because it supplied dollars to the world, and partly because it financed military commitments and domestic programs. Foreign central banks accumulated dollars. Eventually, some began to question the promise. Could all these dollars really be redeemed for gold at the official price? This is the mechanism that made fiat increasingly inevitable. A global reserve currency linked to gold must either starve the world of liquidity or eventually break the link. By the 1960s, the strain was visible and measurable. As dollars piled up overseas, confidence in conversion weakened. Gold outflows pressured U.S. reserves. Policymakers attempted to defend the system through coordination and patchwork solutions, gold market interventions, diplomatic agreements, and policy adjustments. But the arithmetic didn't change. If too many holders demanded gold, the stock wasn't sufficient at the official price. In 1968, the global gold market effectively split into two tiers, an official price for governments and a market price driven by private demand. That split was a warning sign. The fixed anchor was becoming a political fiction. Then came 1971. In August 1971, the United States suspended the dollar's convertibility into gold for foreign governments, often remembered as closing the gold window. This was the decisive break. It didn't instantly produce the fully floating system we know today, but it made it unavoidable. By 1973, major currencies were largely floating against one another. Why did governments accept this? Because the alternative was brutal. Defending the gold link would have required tighter policy, higher unemployment, and deep austerity at a time of political pressure and global competition. It would have required the United States to run persistent surpluses to rebuild gold credibility, meaning the rest of the world would receive fewer dollars, tightening global liquidity. In plain terms, maintaining convertibility would have meant choosing a metal promise over domestic stability and geopolitical strategy. So the system evolved toward what was already becoming reality. Money is state-backed credit, managed by central banks, and stabilized by institutions rather than metal. That choice brought new freedoms. Governments could respond to recessions without waiting for gold inflows. But it also created new risks. Without a hard anchor, inflation can surge if credibility collapses. The 1970s delivered the warning. High inflation and oil shocks showed what can happen when money growth, supply constraints, and expectations feed one another. In the decades that followed, central banks rebuilt credibility through tighter policy, painful recessions, and institutional reforms that emphasized price stability. Fiat money survived not because it was perfect, but because it could be governed, and because many societies preferred a flexible system with manageable risks over a rigid system with unavoidable pain. Today, nearly every major currency is fiat. That doesn't mean money is fake. It means money is a liability of the state and the banking system, backed by enforceable tax obligations, legal structures, and the credibility of central banks. This has reshaped power in at least four ways. Policy became a primary economic instrument. With fiat, governments and central banks can expand the monetary base, support banks, and stabilize markets during crises. Modern crisis toolkits, emergency lending facilities, rapid rate cuts, large-scale asset purchases would have been constrained under strict gold convertibility. Debt became easier to sustain until it isn't. Fiat currencies allow governments to borrow in their own unit of account and refinance over time. That reduces default risk, but raises inflation and credibility risks. The constraint moved from "do we have gold?" to "do citizens and markets trust our institutions?" Distributional politics became louder. When central banks lower rates, the present value of assets rises. Housing, equities, and long-duration bonds can surge. People who own assets gain faster than those who live mostly on wages. This is not a hidden scheme. It's a mechanical consequence of discount rates and liquidity. But it becomes political because distribution shapes legitimacy. The dollar system became even more influential. Once gold was gone, the dollar's dominance didn't disappear, it transformed. The world still needed a deep, liquid, trusted asset for reserves and trade settlement. U.S. Treasury markets became that anchor. This gives the United States outsized influence through funding costs, crisis backstops, and financial rules, but it also creates global vulnerability to U.S. policy mistakes. So when people ask, why did money become unbacked? The honest answer is, because the old backing could not scale with industrial economies, global trade, democratic politics, and modern crisis management. Fiat wasn't chosen because leaders hated gold. It emerged because the gold constraint kept forcing the same dilemma: defend the peg and accept domestic collapse, or save the economy and abandon the peg. Money became unbacked for the same reason modern states built central banks in the first place: to turn financial chaos into something governable. Gold-backed money offered discipline, but it also imposed a deflationary bias and made crises harder to contain. As economies grew more complex and politics became more democratic, that trade-off became unbearable. Bretton Woods tried to keep the gold anchor while adding flexibility, but the global need for dollars eventually cracked the promise. The result is the world you live in now: money backed by institutions, credibility, and power, not by metal. And that brings us to the next question, the one that still divides economists and policymakers. If the gold standard imposed discipline, why did it repeatedly collapse exactly when it mattered most? In the next episode, we'll zoom in on the gold standard itself, how it worked, why it looked stable, and the precise forces that broke it apart.